We're not going to sell no matter how much anybody offers us for.
It's a very good question about selling. So now we sell really when we think that when we're reevaluating the economic characteristics of the business.
I mean, if somebody offers us 3 times what something is worth, we're not going to sell it. I won't do that.
An intellectual quality. You don't need tons of IQ in this business.
Warren Buffett is an investing legend with a net worth of over $100 billion. Today, I'm going to share some of the secrets on how Warren Buffett knows when it's time for him to sell a stock. Most people think that all they have to do is buy low and sell high. But if you're not paying attention, your profits will slip away before you know it. So let's break down the top 3 things to identify when to exactly sell your stocks. Welcome to Gold Bull, the place where future successful investors gather and get inspired. If you have not subscribed yet, you are missing out. Alright, let's begin. When it comes to stock, there are a few things you need to take into account before making your decision. You'll want to consider the market and when is the best time to sell. Generally speaking, stocks tend to go up in value over time. However, this isn't always the case. Sometimes, stocks will dip in value and you'll want to sell before that happens. Like Warren Buffett, you'll want to consider the stock market and figure out if it's a good time to sell through these factors. Number 1. When something better comes along. When something better comes along in the stock market, it's time to sell your stocks. You don't want to be left holding onto a stock that is no longer worth anything. Keep an eye on the stock market and make sure you are selling when it's time. This will help you protect your investment and ensure you are getting the most out of your stock portfolio. As explained by Warren Buffett himself,
the first 20 years of investing for me, or maybe more, my decision to sell almost always was based on the fact that I found something else I was dying to buy. I mean, I sold stocks at 3 times earnings to buy stocks at 2 times earnings 45 years ago.
Remember, you can't put the same amount of money into Company B as you would have in Company A. This may result in difficult choices. You could be forced to stop investing in a firm that you like for something far superior. Just like what Warren did in his 1959 letter to partners in Buffett Partnership Limited. This was the time when Buffett switched his position in a bank called Commonwealth crossed into the mapping business of Sanborn Maps. As written in his BPL letter in 1959, late in the year, we were successful in finding a special situation where we could become the largest holder at an attractive price. So we sold our block of Commonwealth, obtaining $80 per share. I might mention that the buyer of the stock at $80 can expect to do quite well over the years. However, the relative undervaluation at $80 with an intrinsic value of $135 is quite different from a price of $50 with an intrinsic value of $125. And it seemed to me that our capital could be better employed in this situation, which replaced it. Here's where you may have gone wrong with your selling if you've listened to more recent advice from Warren Buffett. Today, he wouldn't sell his wholly owned businesses even if he expects them to deliver subpar investment returns. Another thing to note about Warren Buffett is that he does not hold stocks forever. He has said that he is a big believer in market efficiency and that he wants to be able to sell his stocks when it is no longer undervalued. His stock prices usually increase over time, but he has sold stocks before. Holding forever is just a personal preference of his these days.
Break off relationships with people I like and people that have joined me because they think it's a permanent home. To do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me.
Warren Buffett's company handbook, which was first published in an annual shareholders letter to Berkshire stockholders in 1983, is a case in point. But this concept of Buffett's goes back much further than that. In 1968, Warren took it up a notch in this statement of his. As I mentioned before, we cannot make the same sort of money out of permanent ownership of controlled businesses that can be made from buying and reselling such businesses or from skilled investments in marketable securities. Nevertheless, they offer a pleasant long-term form of activity. when conducted in conjunction with high-grade able people at satisfactory rates of return. After a bad experience with Dempster Mill manufacturing in the early 1960s, Buffett's preference for buying companies began to deteriorate. The city was furious that Buffett had purchased their largest employer and then reduced expenses and jobs in order to make it profitable to sell. However, if we examine his partnership agreement from 1961, when he also had less money, we'll see what I believe that Buffett might suggest smaller investors do. Buying undervalued securities and selling is our bread and butter operation. You as a newbie should know the difference between the two. Number 2. When a company's economic features change dramatically.
Our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. And that happens. So
Warren Buffett has always been a long-term investor, but even he knows when it's time to sell. Here are 3 examples of times when Buffett sold the stock and why. According to a regulatory filing, Buffett's investment firm Berkshire Hathaway discontinued its remaining 10.6 million GE shares sometime in the second quarter. Buffett's investment had been worth $315 million as of June 2017. The timing of the sale was excellent. Those 10.6 million shares would have been worth $46 million less today than 3 months ago. As of the end of 2017, Berkshire had about 2 million shares of IBM, after having sold down roughly 94.5% of its previously enormous position. In 2011, Berkshire revealed that it had bought $10.7 billion in common stock in IBM at an average price of $170 per share. Just recently in 2020, he sold his stake in a few of the major airline companies, noting that the world has changed for airlines due to the coronavirus. Buffett doesn't seem too worried about the virus itself, but he's not taking any chances with his investment portfolio. Finally, with his investment in the grocery chain Tesco, Warren decided to let it go. Buffett doesn't say why he sold his share of the business, but it was due to a problem with the management. He left the position in 2014, however, owing to a small net deficit. Of course, despite all those sales, in 1997, Buffett said that selling fine businesses on scary news is usually a bad decision. Thus, learning the stocks before you sell or invest is a must for everyone. Number 3. When a single holding gets too big. When you have a stock that is making up too much of your portfolio, it's time to sell. This can be difficult if that stock has been doing well, but staying disciplined is key to long-term success in the market. Selling when things are going well protects your profits and allows you to rebalance your holdings, bringing them back to their proper weighing. The age-old advice of not putting all your eggs in one basket is true, but you don't have to be as strict as most people suggest. The smaller your portfolio is, the more you can afford to put in a single stock. Consider that when Warren was managing more than $500 million in today's terms, he had 40% of his partnership's money invested in American Express. The stock surpassed his 40% ownership limit rule eventually, at which point he reduced his stake to maintain some diversification. By the way, this is Warren Buffett's 4th largest commitment. The stock market is a great place to make some money, but it's also really easy to lose all of your shirt. Knowing when and how to sell stocks can be the difference between making and losing huge amounts of money on any given stock pick. While there are general guidelines that apply across the board, you should also consider a company's market value and how it stacks up against the competition. Here are some questions to help guide your decision. What is going on with that stock? Is it being bought or sold? Are people taking their money out of the stock, meaning they think its price will go down soon? How does this stock compare to other stocks in terms of price and value? Or are there any major changes coming to this stock that might affect its future success or failure? Hey, Gold Ball investor! While we can all agree that selling will make someone feel better about themselves, even if they made bad decisions, there are some other factors involved with investing and trading securities, not just your own feelings. Let's go back to Warren Buffett's tips in knowing when to sell. First, when something better comes along. Next, when a company's economic features change dramatically. Lastly, when a single holding gets too big. Did you like this video? Let us know in the comments below. Don't forget to subscribe if you haven't already for more high-quality financial content updated regularly. Alright, see ya!